Hey, what's up, guys? This is James J, the Texas Mortgage Boss, and we are in our final week. Can you believe it? May is coming to an end. So today is going to be video 7, and today we are going to discuss mortgage insurance versus homeowners insurance. Mortgage insurance versus homeowners insurance. Very, very important topic, and one that a lot of first-time buyers often confuse. What's the difference, and what protects them, and what protects the lender? Let's discuss. All right, so what is the difference between mortgage insurance versus homeowners insurance? Okay. This is a super important topic because most people are going to be paying mortgage insurance, just a reality. Okay, so we're going to break down the differences between FHA, conventional, VA, USDA. Those are the main loans that people are going to be using when applying for a mortgage. So we're going to discuss those, and we're going to start with FHA because that is the one that probably is the most confusing for people. And FHA is the most used loan. So we're going to start with FHA and how that works versus VA versus conventional. Okay, so FHA, let's start here. So what FHA does is they're going to charge you an upfront fee, which is 1.75 of the loan amount. Okay, so that normally gets financed into your loan. When you get to closing, you will see 1.75% again of the loan amount. You're going to see that as a fee, and then that normally just gets financed into your mortgage. Now, I've never seen anybody actually pay that out of pocket. You could. I've never seen anybody do it. Okay. So, what is even the purpose of mortgage insurance? Let's start there because one of the things that people tend to confuse the mortgage insurance with is that it's going to protect them some kind of way. Okay, it is not the case. Mortgage insurance is in place to protect the lender. Okay, why? If you're not putting down 20%, which again, most people don't, the lender views that as more of a risk. Okay, because of that risk, mortgage insurance is involved. Okay, so that mortgage insurance is put in place to give the lender a warm and fuzzy. All right, a little bit more comfortable loaning money to a person that's not putting down 20% if they've got that mortgage insurance as a backup. Now, the mortgage insurance is not going to pay the loan in full, but it's going to give a lender a guarantee of a certain amount of money if the loan were to be in default. All right. So that is the whole point of mortgage insurance to begin with, is it's to protect the lender in case of default. That's what it's there for. In the case of FHA, FHA charges an upfront mortgage insurance premium, which is 1.75 of the loan amount. They also charge a monthly. Okay, so there's two. The monthly is what you see in your monthly payment. Okay, the upfront just kind of gets financed into the loan. So you may see a loan amount, and this is very important because oftentimes people will look at the loan amount and they'll say, well, my sales price was 200,000. Why is my loan amount 206.50? Excuse me, $206,500. Okay. The mortgage insurance gets financed into your loan amount. Very, very important that you understand this because this question comes up all the time. They're not understanding, well, why is my loan amount higher than the sale price? This is usually why when it comes to an FHA loan. It's that mortgage insurance, okay? So 1.75 up front, and then you're also going to pay a monthly insurance premium for FHA loans. Now, there are some ways that you can avoid paying the mortgage insurance on an FHA loan for the life of the loan because most people will end up paying it for the life of the loan. Okay, meaning once you get that FHA loan, you're going to continue to pay mortgage insurance unless you refinance the house, sell it, or pay it off. I mean, that's really the only way you can get rid of the FHA mortgage insurance, unless you put down 10% or more. Then you're not stuck with it for the life of the loan. The reality is most people that are given FHA loans are not going to put down 10%. Right? Just not. Could it happen? Yes. Could it? Will it? Probably not for most people. So for most people, you go FHA, you're going to put down the minimum 3.5%. You're going to have that mortgage insurance for the life of the loan. Pretty simple. Okay. But again, keep in mind the mortgage insurance is there to protect the lender. It's not for you. Okay. Now let's discuss conventional. Conventional loans come with PMI, which is private mortgage insurance. Okay. Same thing, different name. MI, mortgage insurance, MIP, mortgage insurance premium, PMI, private mortgage insurance. It's all the same thing. Okay. Just keep that in mind. It's the same thing. Now, on a conventional loan, your mortgage insurance is going to be largely based on your credit score and the amount of your down payment. Okay. So this is one of those things that can sometimes keep people from being able to go conventional depending on your credit score. So credit scores are really, really big when it comes to a conventional loan qualifying period. Largely, and a lot of that qualifying has to do with the mortgage insurance because it's largely based on your credit score. Okay. So when it comes to conventional loans, they don't charge an upfront. Okay. There is no upfront mortgage insurance on a conventional loan. So oftentimes when you start looking at closing costs on an FHA versus conventional, the closing costs may be a little less on a conventional loan because there's no upfront. This is not in stone by any means. Every situation is different. But a lot of times on a conventional loan, because there's no upfront mortgage insurance, the closing costs actually might be a little bit less. So you got to look at that and see which direction is going to be best for you. There are oftentimes I have people that have excellent credit, but they can't go conventional because the debt to income ratio is too high, right? So just because you have 800 plus credit scores doesn't mean you just go conventional. Just depends on the situation. Got off a little tangent there, but I just wanted to bring that up. But on a conventional loan, again, credit score, down payment. Those are the two big factors that are going to affect how much your mortgage insurance premium is. And unlike FHA or USDA, there's no 1% or 1.75, or they don't do it. There's no upfront. Okay. So really strong credit is going to be very beneficial for you when it comes to a conventional loan and the PMI because it is largely based on down payment, number one, but that credit score is the other big factor when it comes to private mortgage insurance. So just remember MI, MIP, FHA, PMI, private mortgage insurance, conventional. All right. Let's talk VA, which is my favorite because I'm a veteran. All right. This will be real quick. There is none. There's no mortgage insurance on VA loans. Okay. One of the things that VA is known for, probably the main thing that VA loans are known for, is there's no down payment, right? That's a big factor when it comes to VA. There's no down payment. So everybody knows about that. To me, the fact that we don't have any mortgage insurance, and I say we because I am a veteran. So if you're a veteran, no, you don't have to pay mortgage insurance, guys. This opens up more qualification for you. All right. When you can go a little bit higher on sale price, get the same payment maybe that you're trying to stay around just because there's no mortgage insurance. This is a big deal. It's a really big deal. It's a big benefit that we have as veterans. Not only do we not have down payment, we also don't have mortgage insurance. So that is a huge, huge benefit for us as veterans. So nothing more to say about VA. Now, they do charge a funding fee, okay? If you are not getting 10% or more disability from the VA, they will charge you a funding fee, okay? A lot of people have disability when you leave the military. You get some type of disability pay from the military, which is large. Most of the time, it's going to be more than 10%. Everybody does not fit that category where they're going to get disability from the VA. If you're still in the military, of course, you're not going to get any disability because you're still in right now. So you're going to end up paying that funding fee, but that is not the mortgage insurance. So I want to be very clear that you know you're not paying mortgage insurance on a VA loan, but you will pay a funding fee. Okay. It's really not the same thing, but I just want to let people know that there is a funding fee. That's just basically a fee that VA charges. It kind of offsets maybe some what a mortgage insurance premium might be. But again, if you've 10% or more, you don't have to pay a funding fee on the VA. The last one is just going to be USDA. Okay, so USDA, what they do is they charge an upfront of 1% again of loan amount. That's what the VA, excuse me, that's what USDA does. So much like FHA, they will charge the upfront and then they will charge a monthly fee, which is usually 0.35 on a monthly basis. So the nice thing about USDA is that it is less than FHA. The challenging thing about USDA is you got to find a house that fits USDA. All right. And there's not a ton of them, meaning every home can't qualify for USDA. It has to be in a USDA designated area. Okay. Usually, if you're in a city, it's probably not going to qualify. But if you want to know, hey, I'm looking for a USDA loan, all you need to do is go to the USDA website. You can type in an address. It will tell you it's eligible or it's not eligible. Okay. A lot of homes where we're at in the Houston area are not going to qualify. You kind of got to get out in the outskirts before you start to see homes that might qualify for USDA. But USDA is a great program, great loan. And it has less mortgage insurance than an FHA loan. Okay, so 1%, and then that's, again, they call it a guarantee fee. That's what they call it, as opposed to FHA, that's just an upfront mortgage insurance premium is what it is. Same thing, different names, but USDA is less than FHA. So that is kind of the differences between the four loans. So we've got VA, no mortgage insurance. FHA, 1.75 upfront. Then you're going to pay a monthly insurance premium as well, which is usually about 0.85. USDA, 1% upfront and 0.35 on a monthly basis. And then you have conventional, which is the private mortgage insurance based on your credit score largely, and also your down payment amount. So that is this video. All right. Make sure you guys go check me out, follow me. I'm trying to put out as much content as I can to help people. You can go check me out on Instagram as well as Facebook, and also go check out the YouTube channel as well. Okay. mortgagebosstv.com. I'll continue to add videos in there. I've got a lot of stuff coming up. We've got one more video in this series. Okay. That'll be the last of this month. Wow, I cannot believe February. Goodness, February. Where am I at? Ooh, I haven't had my coffee this morning. May is over. All right, so we're going to be in June. We're going to start a new series next month as well. And I'll talk about that a little more later on. You guys have a great day.